Well, this week, investors are all but certain the Fed will cut rates on Wednesday. But the question, of course, is how much has been hotly debated during the trading day Monday. Futures tied to the Fed's decision swung wildly. By Monday afternoon, investors were pricing in a more than 60% probability that the Fed would cut by 50 basis points on Wednesday. My next guest is firmly in the half-point cut camp. And join me now, Greg Ip, chief economics commentator and deputy economics editor at the Wall Street Journal. All right, Greg, it is great to see you, as always. You think the Fed should cut by half a point. Make the case, Greg. How come?
Okay, first of all, I don't know what they're going to do. And second of all, I think there's a case for both a quarter and a half. But when I review the evidence and the facts, I come out in favor of the half-point cut. And it all starts out by looking at where rates are now. They're 5.25% to 5.5%. That's the highest in 20 years. Now, when they pushed rates to that level a year ago, they had some justification. Inflation was really high, and they were really afraid it was going to get stuck there. And honestly, they were ready to cause a recession to prevent that from happening. Well, inflation has come down a lot right now. By a lot of underlying measures, it's below 3%. It's in shouting distance of the 2% target. If you look at a variety of forward-looking indicators, I think there's excellent probability that they'll be very close to 2% a year from now. There's no need for a recession now. Having a recession now would be a terrible waste and a big mistake. And so rates just look too high right now for the economic circumstances we have now. They need to get them back to some semblance of normality. Now, whether that's 3%, 3.25%, maybe less than that, I'm not sure, but it's definitely quite a lot lower than 5.25%. And so I would start that process with a half a point just to bring the stance of monetary policy back to something that looks a little bit more logical for the economy that we have today.
What would be the risk, Greg, of cutting half a point as you think through them?
So the biggest risk if you cut half a point is that in the next few months, you get new data that tells you that actually inflation isn't continuing to head down. It's actually kind of stuck here. Maybe it's even edges a little higher. There are certain things out there that we can't predict. Like, for example, what if oil shoots higher again? What if we get higher tariffs in the next 12 months? So those are things that we can't really predict, and I'm not dismissing that the possibility. And if it came along, the Fed would look at that and say, well, looks like we won't be cutting rates as much as we thought we would. But, if they're in that situation, the answer is fairly straightforward. Just don't cut rates the next meeting or the meeting after that. They can, as they like to say, be data dependent.
What are the risks? I guess there would be risk, too, of going for a traditional 25, the norm, Greg, but you must think that's less risky.
Well, no, I actually think that sticking with a quarter point brings more risk.
You're right. More risky.
Yeah.
I'm sorry.
I mean, ask yourself, so your baseline scenario is that the job market stays fine, growth stays fine, and all that, and if that's what works out, it's fine. A quarter point, nobody's going to complain about that. And if you're asking me, I don't think the world will end if they go by a quarter point. It's perfectly defensible. But I like to think about things that can go wrong. And Fed Chair Powell said in his Jackson Hole speech a few weeks ago that the labor market has cooled and any more cooling would be really unwelcome. And I agree. We're now at a situation where job growth is very, very modest. The unemployment rate has moved up about, 0.75 percentage point. Any more weakening in the job market starts to look very, very recession-like, and you don't want that to happen. And if you look at where we've been going lately, there's a more than zero possibility that the next few job market reports could be very weak and that the probability of recession will then look higher. And if that happens and the Fed has only gone a quarter point, it'll be obvious to everybody, including the Fed, that they're behind the curve. And then they're stuck in this catch-up situation of having to cut rates more aggressively.
Greg, we will soon find out, my friend. Thank you for joining the show today. I always appreciate it.
All right, then. Thanks a lot.